And again, I know it's tough, these sessions of 6 hours. Is it better to, again, so we have 2 of these sessions left. Is it better to have a big break instead of smaller breaks? Or does this work better, or do you rather have like 2.5 hours, hour break, 2.5 hours? Better? Not better? Okay. It's too much, huh? Okay, yeah, there is a lot of talking, it's inevitable. This one I like though. So, all these volatility arbitrages that we discussed, all contained, I have an opinion on what volatility should be. I take a position, but at the end of the day, that could go in my favor, but I could also be wrong. It's not an arbitrage. Arbitrage in the true sense of the word is being able to buy and sell and lock in a risk-free profit. So it's not real arbitrage. But there's one strategy that comes close enough. So let's assume the following. I'm building a really simple index. There's 4 shares, A, B, C, and D. And all the shares trade now at $100 each. And they all have exact same 0.25 weight in the index. So stock A contributes 25 points to the index, as do stocks B, C, and D. So the total value of my index is 100 points. So now assume I have the position that's on the screen. So I'm long 100 gamma in each of the shares, and I'm short 400 gamma in the index. So I would like you to think, what happens if all the stocks go up by $1? Nee. Nou. C6 is new. And C6 is empty. A4, B5, B15, C8, c'est pas, no? B10, yeah. Okay, so if all stocks go up by $1, then what will be my delta position in all of these stocks if I have 100 gamma? See? Yeah, so I'm long 100 gamma. Share price goes up by $1. What's my delta change? So if we look at what's the definition of gamma, bear with me. The definition of gamma, here we go, gamma, the change in delta if the stock goes up by $1. So in this case, what do we know for the single stocks? For stocks A, B, C, and D, I'm long 100 gamma. Bless you, stock price goes up by $1. So in order to make this equation fit, what's my delta? 100. So if I start delta neutral, my end delta would be long 100. So in stock A, B, C, and D, I end up long 100 shares. Now, the index equals a quarter times A plus a quarter times B plus a quarter times C plus a quarter times D. So if all stocks go up by $1, what happens to my index? And so first let's do right. So the index goes up $1 too, right? So therefore if the index goes up by $1, the index I'm 400 gamma short. So therefore, on the index level, the index will go up by $1. In the index, where's my mouse? I'm short 400 gamma. So therefore, in the index, I'm short 400 gamma. Index goes up 1 point. I end up short 400 delta. So now my portfolio in total is I'm long 100 shares of A, B, C, and D. And I'm short 400 deltas in the index. But now I can say, yeah, but the index is actually a quarter shares of A, a quarter shares of B, a quarter shares of C, a quarter shares of D. So short 400 index deltas is the same as being short 100A, 100B, 100C, and 100D. So that exactly offsets the position I have in the single stocks. So at the end, this position is totally washed. So what do you see? I go up $1 in the stock, so I end up delta 100 long. How much do I earn in each? Start delta flat, end up at delta 100, so on average I'm long 50 deltas over a share price of $1. So I earn $50 in each of my single stocks. In the index, I start delta flat, I end up 400 delta short, so on average I'm 200 delta short, going up 1 point, so that costs me 200. So what you see, for starters, you see my deltas match, because 400 index deltas is exactly the same as 100 shares of A, B, C, and D. And you also see that my P&L matches. I make exactly as much as the index as I lose in the single stocks. So if I have a portfolio where I buy options in the stocks and sell the exact corresponding amount of gamma in the index, and everything moves, then actually it's all breaks even. But is there also a happy scenario? The happy scenario, what would happen if the stocks do different things? So suppose that stocks A and B go up by $1, and stocks C and D go down by $1. Then my index does nothing. So if I look at it, I have 100 gamma, so we go up $1 in A and B, so I will earn, or I will be long, 100 shares of A and 100 shares of B. Stocks C and D go down $1, so I end up being short 100 C and short 100 D. The index, because it offsets each other, doesn't move, so that also means that I don't have any delta. So now what do I earn? If I start flat and I go up $1, I earn $50 in A and B. But in C and D, I start flat. I end up 100 delta short. So on average, I'm 50 delta short, going down $1. So I also earn $50. So now you see, the index where I'm gamma short doesn't move. The stocks where I'm gamma long each move. So I make money on this same position. That's why it's called dispersion, because if the movement in the stock is in opposite direction, if they disperse, their effects on the index cancel out. The index doesn't move that much. So I don't lose on my gamma short, but I gain on my gamma long. So it's all about uncorrelated movement. But even if it's all correlated, let's say we have the following. Stock A and B go up by $1, and stock C and D go up by $2. So that means that the index goes up by 150. So let's see what happens. A, C, D. Move. Gamma. And of course we have the index. How does the index moves? A quarter times the movement in A plus the movement in B plus the movement in C plus the movement in D. So the index goes up 1.5 points. So I'm short 400 gamma. So at the end of the day, what is my delta position? $200 deltas long in A and B, 100 deltas short in C and D, and 600 deltas short in the index. So, first thing, if I would look at my index, 600 deltas in the index corresponds to 150 short deltas in stock A and B and C and D. So my net exposure is I'm long 50 shares of A and B, I'm short 50 shares of C and D. So just like the previous one, if I want to neutralize my portfolio, I need to buy 50 shares of C and D and sell 50 shares of A and B. So what am I doing? I'm selling the stocks that outperform the index. I'm buying the stocks that underperform the index. Now let's look whether I earn any money on this. So I earn 1/2 times gamma times move squared. So I earn $200 for the big moving stocks. I earn 50 for the small moving stock. And I only lose 450 in the index. So in total, I earn $50. So what is this position about? First, let's take a look. We go down $1 in A and B, up $1 in C and D. Index unchanged, I just make money from order movement. I can buy the stock that goes down, sell the stock that goes up. But even if they change in the same direction, so fully correlated, but if the magnitude is different, so it's not co-integrated, I still earn money. So whatever I tweak with this, there's no way I can lose money. My worst case outcome is if all stocks go up or down exactly the same amount. What would be a great scenario? Let's say all stocks go up, but one stock has a very big down spike. A weird event against the whole market. And now you see I make a boatload of money. But even if all stocks move in the same direction, one of them just moves a lot more, fully correlated, I still make a boatload of money. Why is that? It all boils down to the gamma formula. Half times gamma times move square. So if I have one big move in my stocks, that move fully counts in the individual gamma. But the index moves with the average of the stock. So one big move actually gets smoothed out. So, because, let's say in this case, all stocks move $1, one stock moves $2, so the index moves 1.25. You notice that the double movement here earns me 4 times as much, whereas the 25% higher movement costs me about 65% more. It's all about the averaging. So a dispersion position is really great. Oh, I shouldn't have done this. Oh yeah, I did. A dispersion position is great. I cannot lose money. And whatever configuration of the movement, I'm gonna make money. So if something is too good to be true, most likely it is. So here we see this guy. So I have a position that whatever happens, I break even and sometimes I make money. So if I know I really want that position, all my competitors will want that too. Up to the point that people might be prepared to pay for the position. So overall, you can get a portfolio theta. So let's take a look at the following one. Let's say that stocks A and B have volatility 16. They're expected to move $1 per trading day. And stocks C and D have a volatility of 32%. So they're expected to move $2 per trading day. Then applying the gamma revenue, half times gamma times movement square, I expect to earn $50 from the movement in stock A and B, $200 from the movement in stock C and D. And at the same time, given that implied volatility, I expect to lose from the movement $450. So my total position, if I put this on, I pay $500 in theta, I recoup $450 in theta being short the index, so per trading day I pay 50. So if the market doesn't move, I lose $50. If the market, all stocks go up or down $1, I lose $50. Only when there's a the degree of dispersion, I earn money. So let's take a look. So this becomes gamma revenue, and this becomes theta, a half. So that's the vol. So the volatility, 16%, 16%, 32%, 32%, and the index we put at 24%. So now let's calculate the theta. Let's net as position. So the movement is 100 times dot divided by 16%. Yeah, so here I have the movements. So now I know what's my theta. A half, so that's, wait one sec. So we have the movement realized. We're also going to put in the movement implied. And then we have the whole picture. Okay, so the theta is a half times gamma times the implied move squared, and we put a minus in front of it. And the total profit, adding all the theta and all the gamma revenue. So we make 0. So if all stocks move at exactly their implied and the index 2, it still is a 0 position. If none of the stocks move, you notice, and the index of course is 0.25 times D plus D. Okay, so these are what I need to fit in. These are what I need to fit in. So if none of the stocks move, there's no movement whatsoever, so I get no revenue from gamma, but I did pay $50 in theta. But on the other hand, if we have a nicely some uncorrelated movement, I have two stocks move 2%, down 1%, up 1%, and you see I earn 250. So now, with this configuration, oh shit, oh, yeah. You notice that sometimes there needs to be a little degree of dispersion. The stocks need to move with their volatility and I break even. If there's a very weird move, I still make a lot of money. If stock C suddenly has a profit warning, I'm a very happy man. But you can imagine that at these prices, I would still love to do this. So the price for that dispersion will most likely be bid up further. So how can that be? Suppose that the stocks trade at 16 and 32, then the index would move at vol 24 if they all move in line. Worst case scenario. But I would still like to invest more than that because I wouldn't mind if there's a small degree of loss. So I'm prepared to either sell the index volatility at an even lower level or pay a bit more for the stocks. So what would be a bit more realistic is that I actually sell index volatility at vol 20. So what happens now? At vol 20, I only have an expected move of 1.25%. But because that movement is less than my components, if my components move exactly their volatility, A, volatility 16 up $1, B, volatility 16 up $1, C, volatility 32 up 2, D, volatility 32 up 2, then the real move in the index is 1.5 points. But in the index, because I was willing to sell at a lower volatility, I only get theta based on a smaller move. So therefore, I need a higher degree of dispersion to break even. So it's all a question of supply and demand. If I would say I'm only making volatility 10 in the index, then you see that I lose a huge amount of money if all stocks move their volatility. But I can still make money. If this stock goes down 4% at the same time, then even though I sold the index vol at a much lower level, because the stocks move so much out and about against each other, I still make money. So it's all about how much of that weird dispersing movement do I expect and how much am I prepared to pay for that. And how does paying work? I have either pay a higher volatility for my stocks or I receive a lower volatility for being short the index. So it boils out, if you look at it like here, I have the lower volatility in the index of only 20, so based on vol 20, I just receive less theta. So here you can see in my single stocks, I pay 500 in theta. Being short the index at this lower volatility only earns me 312. So if nothing happens, or if every stock is up or down the same, I will lose $187. So apparently the lower the volatility in the index, the less favorable the dispersion position gets. So that brings us to, I would like to put it in some kind of a number. The desirability of a dispersion position depends on how expensive are my single stock volatilities that I'm buying compared to the index volatility that I'm selling. And it is in a way a correlation-like measure. I'm looking at the variance of the index, volatility squared, because it's with movement, I always use variances. And I divide it to the average of my individual stock variances. And that's a good proxy for the degree of correlation that's expected in the market. It's not the same as correlation, so I named it differently correlation, but for the Dutch belongers, that's really a silly joke. But this is the reason we used to call it at IMC, because it was not exactly correlation, but it really looked like it. So the takeaway for this class, name it correlation or whatever, but we want to look at a dispersion measure. And that depends on what is the implied volatility in the index I'm selling compared to the implied volatilities in the stocks that I'm buying. So if we look at our formula, then the correlation equals, one second. So here I'm doing that correlation number. So let's start that the index trades exactly where you would expect. Or I can even do it a bit higher. So there could be a level that I would have the correlation of the index, of the implied correlation of the index squared being equal the implied correlations of my components. So one question you might ask, if I would type in 24, why isn't that 1? Because that's the average. And the answer, of course, is the variances. Because 32 squared is not, the difference between 16 squared and 24 squared is of course not the same as the difference between 24 squared and 32 squared. The 24 is the average of my volatility, but it's not the average of my variances. So that's why correlation 1 turns out to happen at a slightly higher index volatility. But the moral of the story, the lower the index volatility, the lower the variance of my index becomes divided by the variance of my stocks. The more expensive dispersion is. So that correlation or correlation number is actually a very good proxy for the price of dispersion. It's up to the way that suppose that our correlation would be about 1. That means that I'm actually paying the same in my single stocks as I'm receiving in the index. So that corresponds to getting a dispersion position with 0 theta. That of course is the best there is, because that means I get a position, I pay no theta for it. Worst case, all stocks move exactly the same amount, I break even. And in any other situation, I make money. So correlation 1. Imagine a higher correlation than 1. Let's take a look. If I put in even 30 volatility in the index, that means that even if there's no movement at all, I still make money. Because the volatility I receive in the index is absurdly higher than the volatility in my underlying basket. So the idea is, correlation of 1 or above is as close as it gets to free money. Now let's zoom back to the 2008. This is the reason that I came to Asia. Because in 2008, the whole market in Asia was in disarray. So the Hong Kong indices traded at dispersions above 1. So I can just buy all the single stock, smash the index, and then during the day it actually moved like crazy. PetroChina went up, ICBC went down, the next day they reverted. Same thing in Australia. Australia contains, half the country is miner, and the other half is a banker. So on one day, the commodities shot up and the banks went down the cliff, so the index itself didn't move that much. And the next day they double turned it. So also there, implied correlation traded towards 1, and in the meantime, the implied it traded like 1, and they moved incredibly dispersed. However, remember long-term capital. It's still supply and demand. Because assume the following. So suppose I have, in this case, my implied volatility of the index, vol 24, my basket, da 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 da. So in the end, my correlation equals 1. So free money. So I'm going to do, how do I put on the dispersion? Let's say I sell 100,000 Vega in the index, I buy 100,000 Vega in the stocks. Let's say I have only $100,000 in my margin account. Indeed, dispersion should never go higher than 1%, one correlation. But there's no rule that prohibits it from trading there. Because if the panic even gets bigger, and let's say that the index volatility is now bid to 25, that means the correlation goes up to 1.1, index volatility stays the stock volatility stays the same, index volatility rises by a point, so I do lose $100,000, which might force me to buy back my position. Just like long-term capital management. I can have a position that theoretically is a big, big winner. But it can become even more ridiculous before it goes back to reality. I must be able to sustain that period. People in the market in Asia, if they put it on too big, it was something that even though it's a winner, and it was a big winner, it could still, on paper, mark to market hurt you a lot. If you wouldn't have enough spare capital, you would get a margin call, so you need to unwind the position. Buy back the index, pushing it even more ridiculously high. So again, free money if you can sustain it. This also, here we see the correlation. This also brings us to one aspect of that correlation, because I can earn money from the actual movement, but actually I can also earn money from changes in that correlation. Because if I would plot on the vertical axis the implied correlation, and on the horizontal axis time, then what does an increase of implied correlation mean? That means that index vol goes up and or stock vol goes down. And what does a declining correlation mean? Index vol goes down and stock vol goes up. Agreed? Because index vol is the top of the equation and the stock vol is the denominator. So let's say over here the correlation is 0.90, which is a great level. I sell volatility in the index, sorry, I buy volatility in the stock. So over here I have a profit, because either the index volatility that I'm short went down, or the stock volatility that I'm long went up. So also from the implied correlation I make money. I put on dispersion, sell index, buy the stocks at a high implied correlation, and I would trade out of it at a low implied correlation. So I can both trade the number and I can trade the daily to move day-to-day movements. The one thing you might wonder, suppose that correlation is really low. If the correlation is really low, do I dare to do a reverse dispersion? How does a reverse dispersion work? They call it a Chinese dispersion, and the reason of that is China is still the opposite of the world from the US. Say I do it the other way around. So I'm 100 gamma short in the stocks and I'm long 400 gamma in the index. So if we get a normal day with not that much dispersion, I make money. But my risk is now that the extreme events are now suddenly my cost. The problem with a short dispersion is that you're, again, selling extreme risk scenarios. I only need one Sino-Forest or a takeover or anything, and one stock goes berserk. The index doesn't do that much. A reverse dispersion is really costly. So most people, what they will trade, they put on the dispersion at high correlations, trade out of it at low correlation. Nobody in their right mind would go reverse dispersion at low correlation. So let's go to Hong Kong. So how does it work in practice? Well, in practice, things are a bit less easy. For starters, if I want to do a dispersion, I need to buy options in all of my component stocks. The TAIEX has about 968 component stocks. So that's at least tough. Hong Kong, you have the 8 shares, one of my favorites, about 43, 45 components. Out of that, only 28 have options. Some options are small, so no options. Some stocks are small, so they don't have an options listing. So that already is a problem. Liquid options are even less, because in Hong Kong it's easy to get options in ICBC, CCB, Sinopec, but it's quite a lot tougher to trade options in Jiangxi Copper or Qingdao Beer. So I need to economize, and in dispersion, maybe I trade a basket that is only a small subsection of the overall index. But then I need to be careful. I have an extreme, almost impossible example. The idea is, which companies tend to have listed options? Those are the bigger ones. which companies tend to be a bit more boring? Those are also the bigger ones. So if I build my option portfolio based on what options can I liquidly trade, I'm gonna trade a subset of relatively boring stocks. So in this case, it could be that if I only buy the proxy basket of the big boring companies, the average volatility I pay might be 23. If I would have bought all the options, I would have had to pay much more. So if I then say index trades at 32 and my basket I bought at 23, it looks like a massively bigger than one dispersion. But it's not because the prices were so great. It could also be because I select the cheap stocks, and that's what happened also 2008, 2009.